The Central Bank of Korea left rates on hold as expected. I have Sun Kwon, senior economist at Nomura in Hong Kong, on the line. So Sun, how long do you think the bank will actually keep rates on hold, and what will prompt them to raise rates?
Well, we expect the Bank of Korea to stay on hold all the way through first half next year. Because economic growth actually, we expect it should rise modestly. And then we expect the Bank of Korea to hike interest rate by 25 basis points to 2.75% in the second half next year, by which time we expect the negative up gap to have closed and a CPI inflation to rise over 3%.
And in terms of exports, what are you expecting to see? And do you have any major concerns for exports due to the negative impacts of China's slowdown?
China's slowdown obviously is a negative impact on the Korea export, but I'd like to highlight that Korea export definitely get the positive benefit from the U.S. growth improvement. So, for example, Korea export to the U.S. and also China increased continuously in the first half this year. This is mainly because improvement in China, U.S. the consumer demand, but also some of the Korea export to China is part of a component that will be reassembled in the China and then re-export to outside China. So the recent export data in South Korea suggests that the Korea export is more benefit than the negative impact from the Chinese slowdown.
And what do you think about the recent performance of the won? What have been the driving factors, and of course, what are you expecting to see?
Korea won recently is very stable. So on one hand, we have a large current account surplus. There's a main kind of a big difference between Korea and all the other Asian countries like India, Indonesia. Their current account balance is getting worse and worse. But actually, the South Korea's current account surplus actually increasing a lot. This is mainly because Korea economy get the benefit from lower commodity prices. As a result, even though we see some capital outflows, actually the overall balance of payment is quite stable in South Korea. As a result, Korea won is also stable against the U.S. dollar and also against the major trading partners.
This morning in Asia trading, South Korean shares rebounded. This was helped by improved Chinese exports data, gains in regional markets, and a strong yen. So can you tell me more about this and investor sentiment?
In the beginning of the year, the investors, they are very concerned about the weaker Japanese yen against the Korea won, given that the South Korea and the Japanese exporters, they compete each other in the global market. But very recently, Korea won versus Japanese yen cross rate is quite stable. And also we believe that the big adjustment between Korea won and the Japanese yen currency is already done in the first half this year. In the second half, we expect currency will stabilize at a current level. So I think that could be some positive kind of implication for equity investors. And again, and also today's Chinese trade data strongly suggests that actually the trade growth is okay. Basically, it's a hold up. The same story. We expect the U.S. economy continue to improve, and Europe and Japan will stabilize as well. Then, even though there should be some slowdown in China's demand, but we think the developed market demand, especially in the U.S., will continue to improve. Then overall, it would be positive for Korean exporters. So the better demand from developed market and also stabilizing the currency, I think that's the two positive factors for Korean equity market.
And before we wrap up, could you give me a brief understanding of what we are seeing with government bonds at the moment?
Well, in terms of the bonds, we see there's some continuously positive inflow into Korea bond market from foreign investors. This is quite interesting, because it's some of the emerging countries, like India, Indonesia, or Malaysia in the region, there has been net capital outflows from those countries because the concern about the currency depreciation and also deteriorated balance of payment. But in South Korea, we see that there is a very continuously and also stable capital inflow into Korean bond market. So we think this is mainly because of the better fundamentals in the South Korea, GDP, CPI inflation, current account balance, and also job market all suggest that in Korea is quite stable and solid. We don't see any big kind of a negative kind of the factors for the Korean economy in the down the road. So as a result, we expect the foreign flow into Korea bond market will continue.
Thank you very much, Young-sung, for that. Well, viewers, do stay tuned to Dukascopy TV, and tomorrow I will be bringing you a Targets in Focus. But for now, goodbye.